Hey, welcome back to the channel. My name is Jesse, and today I'm going to be checking out 3M. As always, check out the description. I've got a timeline of the video, so feel free to skip forward to any specific section you want to catch up on. All right, so let's go through a brief overview of the company first. So 3M, I like to say, is just the company that sells stuff, lots and lots and lots of stuff. On their business side, their business product side, they have over 18,000 products. Their consumer side, they have over 2,400 products. And a lot of the products, obviously, you will be very familiar with. It seems like they just sell everything. The amount of brands that they have underneath the 3M company is insane, both across the consumer and the business segments. So everything from Post-its to 3M tape, adhesives, cleaners, just so much different stuff that they kind of have their hands in. So talk about SKUs. So many SKUs, guys. So many SKUs. With that being said, let's get over to the 5-year chart. All right, so here we got the 5-year chart. We can see that overall we've kind of been in a downtrend, shop consolidation. Just it doesn't seem to go anywhere too fast. We have a high of about 255, low about 115 over the last 5 years. Over the last 10 years, we can see that we have had pretty nice appreciation. Kind of made a nice run from 2013 up to 2018. Then we pulled back for multiple years during the COVID crash, got down to about 115, then recovered up to 205, and we're sitting about 129 right now, which 129 has been a pretty good area of support previously, this 126, 128 area. So we'll see where we go from here. We had a gap up off of some news that they were going to be splitting off their medical division, their medical products. So basically splitting that off, so that would be essentially valued separately from the 3M company, kind of trying to extract a little bit more value to shareholders there. And then recently we had this massive sell-off based off of a lawsuit and a ruling from a judge that they cannot basically just have their subsidiary go and file bankruptcy and avoid the lawsuit and take it to basically a settlement, a large settlement. So we'll get into that a little bit later, but yeah, been some pretty interesting price action for 3M over the last, 5, 10 years, and even recently. Another thing to note with 3M is that it's a large dividend payer, so a lot of the capital is returned to shareholders via dividends. So I think the current dividend yield on 3M is about 4.3, 4.4%, something like that. We'll see here in a little bit. But with that, let's jump over to the latest quarterly presentation. All right, and here we have the latest quarterly presentation. I'm going to breeze through this and maybe highlight some things here and there. And they hit on some of the things we just talked about, kind of go over creating value through the spin-off the healthcare and then taking action to resolve combat arms earplugs litigation. That was the lawsuit I was talking about. So kind of front and center, page 3 of the presentation, just kind of their objectives of creating more value through this and how they're going to try to resolve the aero technologies and related entities issues with the combat arms earplugs litigation. So they filed Chapter 11 to try to resolve it and kind of get to a larger scale resolution quicker instead of going through like a lot of small litigations. And that just got denied by one judge. So that huge 10% drop that we just saw is due to that. So yeah, we can talk about that later though. Here they touch on kind of the new 3M as well, kind of splitting healthcare and the overall 3M business and what that's going to look like. So that is definitely a big part of their objectives. Here they're just touching on looking at megatrends that would favor 3M science and innovation over the next, decade or so. So they're looking at these different areas and seeing how they can capitalize on it and how they can innovate and basically take advantage of the overall market trends that are going to be happening over the next 5-10 years. Now they're going to give us a little sales pitch on, hey, Innovation, talent, operations. We're great. Good job, guys. Good job. Enabling better, smarter, safer healthcare. Just a big sales pitch. Nice little presentation, but no, I care usually more about financials than investor presentations. Financials tell the real truth, the real story behind the company over the last 10 years. So we'll see what else we got here, if we got anything good. This is an interesting slide, business group performance. So we can see safety and industrial, we've got a 0.7% organic growth, 21.5% adjusted operating margins. Transportation and electronics, 0.5%. Healthcare is 4.4% growth. Consumers, negative 2.5% growth. So saw a reduction there. So we get a good idea of the growth and the margin rates across these different business groups. Now, 3M is not going to be a crazy grower. They're probably going to keep up with inflation. I think probably one of the benefits is going to be that they're going to be able to pass on costs to consumers and kind of be a decent grower with inflation and with GDP and just with overall economic growth. So we're probably going to be looking at 3% growth in the coming years. But you're not going to be getting into something that's going to be a drastic high 9, 12, 15% year over year grower, in my opinion, unless something drastic happens, which I'm not going to count on. All right, so here we can see that they revised their guidance a little bit downward, basically just due to macroeconomic factors. They were previously guiding about 2 to 5% organic growth, and now they're guiding 1.5 to 3.5%. So they're seeing a little bit of contraction with a lot of other companies right now. And then they just give us a brief rundown of different financials, which we will get into later. We can kind of see the regional growth though. So Canada, Mexico, Brazil are having decent growth. China's contracting. Japan and US are pretty much flat. So that's something it's a little interesting to take note of. All right, let's go ahead and jump over to some of the latest news. Here we got the news that we were talking about with what sent it down 10% in one day. And we can see the 3M can't use bankruptcy to halt lawsuits over combat earplugs. Judge rules. So basically they said that, the judge basically said that they can't use a bankruptcy of the subsidiary that these combat earplugs are being sold under to kind of pause the trial. So it's going to go to trial. I think I was looking at there was something like 230,000 cases or something like that. Yeah. 230,000 service members. So it's a pretty big litigation. And it's one of those things where I'm just kind of whatever happens with it happens with it. Obviously I am going to be fairly neutral in this. Whatever the jury or the judge deems necessary for the settlement, cool, that's fine. I'm not rooting one way or the other, honestly. But we have to take it into account when we look at it from an investment perspective of how much could this affect the company. Some people have said that it's could be $100 billion in damages. And then people kind of laugh that off. Even some people on that side and was that's way too high. So we'll see what happens. But it's definitely something to keep in mind. If we go back to the price chart, it's kind of interesting because we see that right here was the news of the healthcare split off. We had this nice rally and upward movement. When this happened, I thought, 3M probably got away from me. And then we started faded back down, and then we just tanked. And we tanked on a really, really high volume. We've got crazy amounts of volume right here. So to me, this indicates that with that much volume, we could probably be looking for more downward momentum, continued downward momentum. So we'll see where this ends up going, if we can get down into that $100 range, or even lower. All right, with that being said, let's go and jump into the evaluation sheet. Let's go ahead and pull up 3M. Ba-ba-bum. And there we go. All right, so we can see that currently it's paying out about a 4.61% dividend. I'm going to go over some metrics before I go into my assumptions, but we can kind of see that over the last 10 years, it's been pretty flat. I mean, we've had some growth and contraction, but it's been pretty consistent. So a lot of the share price appreciation has come from multiple expansion, and we can see that in the bottom line yields going from 5, 7, 8% down to 2.5, almost 2.5, 3% to 4%. So a lot of the share price appreciation has been from that multiple expansion rather than drastic amounts of growth. So margins have stayed pretty consistent and have started shrinking lately, most likely due to supply chain issues. I would assume that with the need of the product, they're probably going to be able to raise prices over the next year or two and get these margins back in line with historical averages. So that's a plus with this company, is I think they have that pricing power to be able to do that. ROA, ROE, ROC fairly solid until recently. Kind of that one-off, fully diluted shares outstanding, steady buybacks, so that's been pretty good. Squiggly lines, just growth metrics year by year. But yeah, let's get into the income statement now. All right, so income statement, we can see just basically the same thing that we saw previously, pretty flat. We see a little bit of expansion, contraction. So it almost looks kind of cyclical over the last 10 years. We can look at their expenses, fairly consistent. We have a little bit higher increase in expenses over the last year or so, specifically in, I believe, is R&D and let's see, selling, SG&A, and then operating expenses. So we did see some increases. My expectation is that those will moderate, and then margins will improve as they're able to increase the cost of goods. EPS diluted, we can see the EPS growth, or growth, contraction, growth. So kind of slow and steady move upward. Weighted shares outstanding diluted, slow and steady downwards. So buying back shares, paying out dividends. If we go on over to the balance sheet, we can see that they don't have like a ridiculous amount of cash on hand. They've got a decent amount. They've been able to manage it fairly well over the last 10 years. Total current liabilities, total current assets, pretty much in check. The goodwill and tangible assets, small increases here and there, but nothing insane. And then we can see the stakeholders' equity or stockholders' equity, capital lease obligations, retained earnings. Retained earnings has had nice steady increase over time. So basically, I mean, I feel like this is like the like description of a boring stock. Like like nothing crazy, just kind of like they're just kind of putting along. Cash flow, more of the same story, just kind of putting along. Like like they sell their goods, they make some improvements, they slowly grow with overall GDP, with overall growth, but we're looking at like 3% growth or so. Free cash flow, net change in cash. We can see really where they are distributing their cash flow to. A lot of it has been previously debt repayments, dividends paid has been steady and growing. For a little bit back in 2013, 14, 15, they were doing a decent amount of stock repurchases, and that's kind of moderated lately. We'll see if they get into a strong financial position, if they're going to be able to ramp that back up. And yeah, so everything just kind of hasn't moved a lot. Just super steady Eddie. Ratios metrics. You can see here, we talked about the margin decrease. Yeah, pretty much nothing insane. It's not really like going up and to the right. It's just kind of steadily going. Per share metrics, net income, operating cash flow, free cash flow, you can see has been very stable, consistent. Some dips, some rises, but overall pretty much moderates. You could say it's probably seeing like a slight uptrend, but nothing insane. Yield metrics, we can see that, we've been staying at similar yield metrics, maybe going down a bit here and there, getting a little bit of a multiple expansion on the valuation side, but it's been fairly consistent. And then dividend payouts, we saw steady rises over that first 5-year period from 2013 to 2017, or 2012 to 2017, and then pretty much a moderation. So they haven't been raising dividends a ton. Looks like they've been doing a lot of debt repayment lately, getting their balance sheet in order. And then growth percentages, we can kind of see revenue, gross profit growth. Nothing crazy, right? A couple percentage here and there, and then we have retraction, and then a couple more percents here and there, retraction, and then some more growth. So it's not going to be any type of crazy grower, but it's not going to randomly just go away either. Dividends or dilution buyback, we can see the amount that they were buying back in certain years. We kind of talked about that 2013 to 2017 area where they did a lot more buybacks, and we saw that in that cash flow statements, and then they kind of stopped buybacks, and then over the last 12 months, I think might have actually diluted a little bit with stock-based compensation and the lack of buybacks. But then we have EPS growth, so pretty consistent, nothing crazy. Dividend growth, we can see some good dividend growth over that 2013 2017 area, 18, and then kind of died down a little bit. So we'll see if that picks back up. But all of that to say, historically, when we get into the overall valuation, we've got like bottom line growth has basically been about 2.29%. Our revenue growth has been about over the last 5 years about 2.23%. Gross profit growth 1.13%. So we're not looking at a lot of growth, but we're looking at a lot of stable revenue, right? From the need and the demand of the products. Okay. So with that all that being said, I can have my scenario played out here. Targeting a base CAGR of 10% and margin safety 2.5%, but we're also getting a 4.61% dividend yield. So I could probably bring that down. That's a pretty high target CAGR for a company that's not really growing, and then also paying out a pretty substantial dividend. So I'd say this is probably a little bit safe. I could probably stretch it a little bit more if I wanted to do a base CAGR of like, let's say 7.5. But we're gonna go with 10% for now. So in my different scenarios, from the very bearish to the very bullish standpoints, we've got the 10-year treasury risk-free rate going from 4.87% in the bearish scenario to 1.99% in the bullish scenario. Dilution in the bearish scenario of 0.6% buybacks to 1.91% buybacks. Bottom line growth in the bearish scenario of 1.4 and 3.5 in the very bullish scenario. We have 5.7% EBIT yield spread in the very bearish scenario with a 4.27% yield spread in the very bullish scenario. Net yield spread 3.81 in bearish, very bearish. Yield spread of 2.85 in the very bullish. Free cash flow, very bearish yield spread would be 4.23 with very bullish 3.17. So I have this in a fairly tight range, mostly because that's where I just believe probably the fair value is and what I would be happy spending for the company. When when we're not trying to project out, like, if a company's growing 30%, well, there's a lot of risk if they stop growing at 30%, right? So, but because this is so stable, we can have, I feel more comfortable having a pretty narrow spread between these various scenarios. So with all of that, we can see that the 2026 fair value price estimate for the very bearish scenario is $129. For the bearish scenario, it's $154. For the base case, it's $184. For the bullish case, it's $221. For the very bullish case, it's $267. In order to get to my target rate of return of 12.5%, not including dividend, I'd have to get about 147 for the very bullish case, 122 for the bullish case, 101 for the base case, 85 for the bearish case, 71 for the very, very bearish case. I think the most realistic possibility probably is going to be about the base case. I mean, if it went into that $85 range, that would be like a no-brainer in my mind for my personal position of looking at establishing a stake in the company. So really, I'm probably going to be looking a lot heavier at the $110 to $85 area. If we can go to the watch list now, we'll go to the watch list. We can see it's kind of in that, let's see, very bearish or very bullish zone. So we're inherently getting a lot more risk if we're assuming that the future is going to be in that very bullish price point. So I'm going to go ahead and I'm going to copy this. We're going to go and do that. Oh, whoops. Let's see. I want to paste numbers, and then we're going to go that. And we're going to bring that into the watch list. So I'm creating this watch list after I do basically every single evaluation, and I'm just to keep track of it. You can kind of see my price points for all these different companies. The only one that's really in the green right now, for which, and green, which means like, which is in a more ideal buy zone or tempting buy zone, is Meta. I still need to populate this with a lot more stocks. I just haven't done it yet. So I need to get Google in there and a whole bunch of others that I've ran. But so for now, this is what I got on the watch list going forward in the future. And then here are all the target KGAR assumptions for these. Going forward in the future, whenever I do an evaluation, we are just going to add it to the watch list. And that way we can just, pop over to the watch list randomly and see, hey, what's in what I would consider an ideal buy zone. And then if I have capital to allocate, I can look at allocating that capital towards the companies that I believe are in my ideal buy zone. So this one went a little bit long. Hope you enjoyed it. If you did, like and subscribe. Be coming out with one valuation video every week and maybe some random content here and there. So hope you enjoyed it. Have a great day, and we will catch you later.